Welcome to the Clinton Donnelly Show, where we explore how tax and regulation affect our everyday lives. This is going to be a very exciting show because we're going to be discussing the most recent IRS proposed regulations on the taxation of cryptocurrency. These are earth-shattering. What has happened? On August 25th, IRS released proposed regulations. Now, these are really substantial regulations. There are many, many pages. They're complicated, somewhat circuitous, and it touches a whole bunch of areas about how people report 1099s on crypto transactions, how we report our gain on our tax return, and a slew of other topics. And it's very, very complicated. It's going to dramatically transform how we prepare our tax returns. It's going to change the crypto industry because the new regulations are going to put burdens on existing companies that they may or may not want to continue operating in the way they have. And it's going to be very disturbing. It's going to be very transformational. We are in a period right now where the IRS, these are just proposed regulations. We have until the end of October to file comments about their regulations, about concerns we have about it. And then at some point after that, they may change them and then make them permanent regulations. So these regulations are not law now. High likelihood that they will become pretty close to them are going to become law. So let's just dig into it. And with me to discuss this today are two of my team members, David Canedo, who is the product lead at our company, he's the manager, and he is an incredible expert on crypto taxation. Also, I have with me is Ben Webber, who is the director of crypto analytics at our company and really wrestles with how we calculate gain, an important topic for most of you listening. David is really an up-and-comer in the crypto tax space. He recently, just today, had published an article in Bloomberg Tax, which is one of the top tax journals in the country, talking about these regulations. So, David, real quickly, what are the key things that these regulations are doing?
Thank you, Clinton. Hey, I appreciate the introduction, and as always, happy to be here. Always good to be on the show. Yeah, honestly, I think so excited to talk about these regulations. And when I say excited, I don't mean to use the term wrong, but it is exciting because this is what we've all been working for. You, Ben, all of us that are in the industry trying to help the U.S. taxpayers with their crypto taxes. This is everything we've been waiting for: regulations, something that we can actually work with to change the reporting to make things more better for the U.S. taxpayers. But I think the long and short of it, I don't think that we're overselling it when I say that these regulations have the potential to completely kill DeFi and change crypto as we know it. And again, I think it's a pivotal time to be paying attention, to be looking at what the proposed regulations are saying. And by the way, as you said, they're proposed regulations. This is the right time to rally as an industry, to look at the regulations, look at what they're proposing, analyze them, and offer feedback so we get good laws.
Very good. So one of the things you wrote about in your article was how they have proposed a very comprehensive definition of what is a digital asset broker. And this definition of who is a broker then puts a burden on them for reporting obligation. You thought that this was going to be overwhelming. Can you tease that out for us, please?
Yeah, definitely. So as you remember, a couple of years ago when the infrastructure bill got signed into law, that basically said that any brokers of digital assets are going to have to issue information reporting, 1099s. What we didn't know was who is a broker for the purposes of these regulations. Well, we saw that. And this clarifies that the definition of a broker in the section 6045 is going to include any person who, for consideration, is responsible for regularly providing any services effectuating transfers of digital assets on behalf of another person. Okay, what does that all mean? Well, first, if we take a look, by the way, they also define that a person can be another person, an entity, a business. Again, a person can be multiple things. Now, also say that online businesses, such as operators of trading platforms that hold custody of their customers' digital assets, and operators with sufficient control or influence over non-custodial trading platforms that affect sales of digital assets made by others, would be considered brokers. So again, what we're getting at is a definition of brokers. It's not just the exchanges as we thought it was going to be. Anybody that's, again, effectuating a sale, anybody that's helping, a client do a sale. So when I'm taking a look at this, again, looking at DeFi, well, that's basically all of the DeFi exchanges. That's Uniswap, that's SushiSwap, it's all the swaps, right?
So what is the reporting obligation that they have? What does that look like? When a taxpayer gets a copy of that report that these industries sent to the IRS, what is that going to look like to them?
So here's why this is such a big deal. Because again, you might think, okay, they have all the data, right? All these DeFi platforms, all the different exchanges have all the data. Why can't they report? Well, consider that for the centralized exchanges, and Ben, you can comment on this in a second. I'm very curious to hear how you've seen the data from your perspective. But centralized exchanges are one animal. It's a whole different animal when you're trying to tackle DeFi now. As anybody that's not fully aware as to how DeFi works, basically a developer puts together a smart contract. The group of smart contracts together, bundled together, they create a decentralized app, what we know as dApp in the DeFi world. With these dApps, any user can connect their own wallets. Again, a wallet where I'm talking about any type of browser wallet, even your unhosted wallets that you control the keys to. You can connect a lot of these and interact directly. You can trade directly with other people. You can trade your assets. You can trade your Ethereum for Uniswap, whatever it may be. So the key here is that you're doing these trades without a central party in the middle. You're relying on the smart contracts, the liquidity providers, and the automated market makers. You're relying on all these protocols to make the matching. Point being, none of these protocols have been developed from the ground up to capture the data and to issue reporting from a centralized office to every single customer. The way the protocols were developed was in a way that you could create the code, put it out there in the web, and anybody could use it. Yes, the information is always online, but just the flow as far as who is going to get the data, who's going to issue the 1099s, who's going to be in charge of this, even the KYC part of it, these are not things that are inherently part of the platforms.
So let's follow up on that, Ben. One of the challenges, these brokers are going to have to report what we call 1099 DAs, which basically is going to be the total amount of proceeds and income that they've had from trading and other activities. What's your take on how accurate these forms have been? I think people have had problems with these sorts of forms in the past, haven't they?
Yeah, I mean, just looking, the past few years, we've seen centralized exchanges issuing these forms. Specifically, one example is Uphold, and they have serious limitations. One, they don't always capture the cost basis for tokens that are being sold on the platform. And that's because some of these tokens that are being sold on Uphold, for example, were purchased on another exchange like Coinbase and transferred from Coinbase to Uphold. So now they're just reporting the proceeds without the cost basis, which is grossly over reporting the income for the taxpayer. The other issues we saw with the 1099s is they weren't reporting certain types of transactions. I believe it was crypto to crypto transactions they were just ignoring. And so, I mean, that's only like half of the equation, right? If you're trading crypto to a crypto, you still have to calculate your gain. But if they can't do this, what's the point in filing a form 1099 anyways? That's grossly incorrect. So, I mean, take all these problems with reporting for centralized exchanges and now bring it to DeFi, and it's much bigger. With DeFi, you have people interacting with protocols, and then they'll take their asset, send it to another wallet of theirs, interact with a different protocol. So how can these protocols keep up with people who are, using multiple wallets? How can the basis be tracked from wallet to wallet? At the moment, it's just not possible from the point of view of these protocols and these DeFi exchanges.
So it sounds like, Ben, that when these rules go into effect, that at the end of the year, these a lot more companies will be sending 1099 DAs to the IRS and to the individual taxpayer and reporting a lot more income. But as you said, these forms are typically incorrect, at least in terms of the gain. They'll report the proceeds, but the gain is going to be all over the map. So this means that the IRS is going to be much more aware of who is engaging in crypto trading, and they're going to have much more visibility to who all the crypto traders are. They just came out on this past Friday, and they said that they believe that 75% of all crypto owners are not reporting their cryptocurrency income and losses. When we see a more aggressive IRS and we see these misleading and an increase of these 1099s, is this going to result in more troublesome audits for crypto traders?
Yeah, I think it's going to potentially cause more audits. And then, it's just going to be a huge mess trying to sort out all this information from the incorrect to what actually is reality. And that's, we've seen it before in audits of our own with, information that we give to the IRS. They already struggle with sorting through it. I imagine there's going to be a lot of people out there getting 1099s that are, not accurate and that are going to get reported to the IRS. And I think people will be afraid.
Well, anytime you get a letter from the IRS, that terrifies most people. That's for sure. David, you said in your article in Bloomberg Tax that you thought that these new regulations have the potential to kill DeFi as we know it, not just in the U.S., but possibly in other parts of the world. How serious is that?
I mean, don't they? What do you think, Clinton? To me, from my perspective, think about it. The way that DeFi has been built from the ground up, it was permissionless peer-to-peer network the problem is financial inclusion to a lot of people. We're not thinking about the US, we're thinking about a lot of developing countries where people don't even have access to bank accounts. Now, we know that a lot of people are using DeFi to trade, make money, liquidity pools, other things, financial services. But point being, the initial use case was, let's come up with a system that we can remove the central party to make a more efficient system of trading, providing financial services, and financial inclusion, right? Well, these regulations, again, if you have to do the reporting, if somebody has to keep track of all this data, if somebody has to do the KYC for every single customer that interacts with your DApp, when you think about all that, unless you start over from step one by starting to redefine the smart contract and having the smart contract ask you for your social security number, you get where I'm going. Unless you redo the whole system, you're not going to be able to get the reporting to do the type of information reporting that we're used to. So again, if you want to put this layer of reporting on DeFi, my fear is that we're not going to have DeFi anymore. It's not going to be the permissionless system where anybody can access it for no cost because you have no third-party costs really, other than transaction fees. Now you're going to have a huge overhead. Think about it. Now you're going to have to have somebody reporting. You're going to have the KYC officer, AML officers, all this different overhead that is basically not going to make the exchange decentralized anymore. So again, to my point, and I don't know how you see it, but if you do this, DeFi is not going to be DeFi. DeFi is going to be some version of centralized DeFi. What do you think?
Well, I think the KYC obligations that they're putting on people just for tax reporting mirrors significantly the global anti-money laundering regime through the Financial Action Task Force. And the principal weakness of those regulations is that it depends on centralized authorities. For example, the Financial Action Task Force depends on every country governing all the activity inside each country. So, you have like 200 countries, and then they put a financial information control unit group there, and then they control all the accountants, the lawyers, and all the gatekeepers in each country. Well, the problem with DeFi is all of a sudden we're not really linked to a country anymore. So it undermines this fundamental concept of financial regulation that the world has of centralized authority. We have decentralized. True decentralized, and by that, I would maybe point over to like Bitcoin, where a protocol was put out there and other people implemented it. Now it just lives on its own. It is upgraded only by consensus approval, but it is decentralized. There's no one person you can go at to say you are in control of Bitcoin. Now, the problem we have is that many other blockchains are not constructed that altruistically. That's a weakness. I know other blockchains where the creator tends to hold to himself a vast amount of coins, maybe a majority of the coins. So he never really gives up control of his decentralized blockchain. So it operates in a decentralized manner, but there's one person who has a governance position in excess of 50% and therefore controls the blockchain. So there's simply a lot of blockchains that are like that. And, a lot of them they're quasi-decentralized. People think of them as decentralized, but they're quasi-decentralized. I don't think it's going to kill DeFi. I don't think blockchain is going to stop. As we see with all regulations, when the government clamps down over here, creative minds move over here, and so it's just a matter of how do they work the loopholes to exploit these weaknesses. And it'll take some time to work it out. And I tend to think that the primary loophole in this attempt to regulate DeFi is you have to really embrace decentralization. Not everybody's done that. Look at Uniswap. All right. It's a U.S. entity. It's a company. They created a protocol. Yeah, they threw the code out there, but they're the ones that have the control over the upgrades. So they retained a certain level of power. And since they're U.S. based, Uniswap would have all these reporting obligations, or they would have to introduce it somehow. Now, I think the way around that would be to create a non-U.S. corporation that's not controlled by Americans. Let's say the Americans on that controlling board represent less than 50% of the voting share, so to speak. And then they would hire as contractors, not employees, could be Americans, anyone, to write the code. And then once they've written the code, then they altruistically release it to the world. This code typically would have a governance token associated with it, and that governance token would be held by, the node operators or whoever. But basically, you have a distributed governance token so that no one person really can be said to control or effectuate the sale of digital assets. In that manner, the blockchain, in a sense, has no reporting obligations. The original company that created the code, they have no ownership of the blockchain. So they merely created the code, and what happened, as long as there's not too many connected ties. You will also, in a blockchain, you need to have a fund, a treasury, if you will, that can fund improvements in the code, help make sure there's liquidity, and do promotion of the coin in marketplace. One way of doing that is to create a second company, could be U.S., could be non-U.S., that does those activities. These parties are not effectuating the sales. They're merely creating more code. If they're doing market making, they might have a reporting obligation, but that's a little bit different, I think, in these regs. But if they do code modifications, they don't implement it by themselves. It's a code it's something that's voted on by the governance group, and therefore it's the governing groups that's implementing it, the code these people drew. So I don't think the second company has a reporting obligation. In this manner, I think we can create a structure by which DeFi would still continue, but we have to really embrace true decentralization. Here at the Clinton Donnelly Show, we're going to have multiple shows going forward where we're going to break down these proposed regulations in a little bit more bite-sized chunks. Today was just an overview, and really tease out the implications and where are the loopholes that we see, where do we think we can go, and of course, watching what developments happen with the hearing and the final regulations. And I think what's different about our channel versus a lot of other channels, they might be whining about these regulations and what an attack it is on DeFi, et cetera. But here on this channel, we're going to tear it down, break it apart, and make it information that you can use, whether you're a trader, whether you're a crypto firm, that you can understand how these regulations are going to affect you, what your options are, and what steps you can take to protect yourself. So please subscribe and like our show and recommend it to others. Thank you very much, Ben. Thank you very much, David, for your contributions. I look forward to talking to you some more about this in the future. I have one last word to say, which is taxes are sexy.
The Clinton Donnelly Show, where we explore how taxation and regulations of cryptocurrencies affect your daily life as an investor. Clinton has a law degree in international financial regulation. He is an enrolled agent and certified as a cryptocurrency anti-financial crime specialist. He has clients in 71 countries. He is one of the top experts in crypto taxation in the US. This show is sponsored by CryptoTaxAudit.com, the income tax experts for US crypto investors. Are you frustrated with using online crypto tax services to calculate capital gains? Are you a high-frequency trader, DeFi, NFT, play-to-earn, or whale investor? Nothing is too complicated for the experts at CryptoTaxAudit.com. Are you frustrated that your accountant doesn't understand crypto taxes? Crypto Tax Audit uses a proven, bulletproof crypto tax return methodology to prepare a tax return that doesn't attract the attention of the IRS. Crypto Tax Audit also offers an exclusive audit defense membership service. It's like car insurance for your tax return. If your return gets selected for an audit of crypto reporting, they will defend you at no additional charge for the entire life of the audit. No one offers anything like audit defense membership. Go to CryptoTaxAudit.com to learn more and schedule a private tax consultation now. The opinions expressed in this show are not legal advice. Tax and regulations are complicated. Your situation is unique, so you should always consult a tax professional.